Bed Bath & Beyond was once one of the most popular home goods stores in the United States. People went there to buy towels, sheets, kitchen tools, small appliances, and decorations. For many years, the company seemed strong and stable, but over time, problems slowly built up. These problems involved debt, changes in shopping habits, and poor business decisions. Eventually, the company could not survive. This is how Bed Bath & Beyond collapsed. Bed Bath & Beyond started in 1971. The idea was simple. The stores were large, clean, and filled with many choices. Customers could walk through long aisles and compare brands. The company also became famous for mailing coupons. Almost everyone had a 20% off coupon, and the store always accepted them. This made shoppers feel like they were getting a deal. For many years, this model worked very well. Bed Bath & Beyond grew across the country. It made steady profits and did not change much because it did not think it needed to. That was the first major problem. As time went on, shopping habits began to change. More people started buying things online. Amazon and other websites made it easy to compare prices and have items delivered to your home. Younger shoppers especially preferred shopping on their phones instead of driving to a store. Bed Bath & Beyond was slow to adapt to this change. Its website was basic and hard to use compared to newer online retailers. Shipping was slower. Prices were often higher than online competitors. While other retailers invested heavily in online systems, Bed Bath & Beyond stayed focused on physical stores. At the same time, the company's stores became outdated. Many locations looked old and cluttered. Shelves were packed too tightly. Signs were confusing. Stores did not feel modern or exciting. Competitors like Target and Walmart updated their layouts and improved their in-store experience. Bed Bath & Beyond did not. Another major issue was the coupon strategy. At first, coupons helped attract customers, but over time, they trained shoppers to never pay full price. People would wait for coupons and refuse to buy without them. This hurt profit margins. The company sold many items but made less money on each sale. While sales were weakening, Bed Bath & Beyond took on more debt. Debt means borrowing money that must be paid back with interest. The company borrowed money to buy back its own stock. This is called a stock buyback. The goal was to raise the stock price, not to improve the business itself. Instead of using money to improve stores, upgrade technology, or lower prices, the company spent billions on buybacks. This reduced the amount of cash available to handle future problems. When sales dropped later, the company did not have enough financial flexibility. In the late 2010s, competition became even tougher. Online shopping kept growing. Shipping got faster and cheaper. Customers expected better websites and quicker delivery. Bed Bath & Beyond continued to fall behind. Then leadership changes made things worse. In 2019, the company brought in new executives to try to fix the problems. These leaders decided to make big changes quickly. One major change was shifting away from national brands. Instead of selling well-known products customers recognized, the company introduced many private label brands. These were products made specifically for Bed Bath & Beyond. The idea was to increase profits by cutting out middlemen, but it backfired. Customers came to the store looking for familiar brands and could not find them. The new private label products did not have strong reputations. Shoppers became confused and disappointed. At the same time, inventory management became a problem. The company struggled to keep the right products in stock. Some items were missing, while others piled up unsold. This made stores look messy and incomplete. Then the COVID-19 pandemic hit. At first, people stayed home and bought more household goods. This helped some retailers, but Bed Bath & Beyond was not ready. Its online system could not handle demand well. Shipping delays and website issues frustrated customers. As the pandemic continued, supply chain problems increased. It became harder and more expensive to get products. Shipping costs rose. Inflation pushed prices higher. Consumers became more careful with their spending. By this point, Bed Bath & Beyond was losing money. Sales were falling. Debt payments were due. Vendors, meaning the companies that supplied products, became nervous. Some vendors demanded payment upfront or stopped shipping goods altogether. Without enough inventory, stores could not sell much. Without sales, the company could not generate cash. This created a downward spiral. To survive, Bed Bath & Beyond borrowed more money. But lenders charged high interest rates because the company was risky. More debt meant higher costs, which made losses worse. The company tried closing stores to save money. But closing stores also reduced revenue. Fewer stores meant fewer sales, which made it harder to pay debt. By 2022, the situation was very serious. The company warned investors that it might not survive. Its stock price collapsed. Cash reserves were almost gone. In early 2023, Bed Bath & Beyond filed for bankruptcy. Bankruptcy does not always mean a company shuts down completely, but in this case, it did. Most stores closed. Employees lost their jobs. The brand name was later sold, but the original business was finished. In simple terms, Bed Bath & Beyond collapsed because it did not adapt. It relied too long on old habits like coupons and big stores. It ignored changes in how people shop. It took on too much debt instead of investing in the future. When problems piled up, it did not have enough money or time to recover. The collapse did not happen overnight. It happened slowly over many years as small problems became big ones. When the company finally tried to fix things, it was already too late. That is how Bed Bath & Beyond went from a household name to bankruptcy.